Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research at the University of Buckingham. I'm giving a presentation on prospects for 2018, talking in mid-October 2017, so we only have a few weeks left of this year, and people are starting to worry about what happens next year. One of the big talking points has been quantitative easing. Many of the pundits were worried about the introduction of quantitative easing in 2008 and 2009. They thought it was a mistake and indeed in many ways rather wicked. And central banks are now talking about withdrawing QE, and withdrawal of QE is also being spoken about as if it's a mistake and rather wicked. Anyway, there are some important implications for the world economy. I want to focus today on only two economies, the American economy and the Eurozone economy, because they are the most important of the developed country economies, and my time is limited. Now, in what I say, there are going to be some underlying assumptions. And the first of these is that in the long run, the rate of growth of nominal national income and broad money, the quantity of money, are related. They're not identical, but they're related, so that if the quantity of money rises by, say, 10% a year over a decade, the growth rate of nominal national income will be similar to 10%. And then further, if you get a sharp slowdown in the rate of growth of money, particularly money after adjusting for the effect of inflation on real money balances, you tend to get a recession in the extreme, and certainly beneath trend growth in normal circumstances, often with asset price weakness. My further assumptions are that the rate of growth of money, which nowadays is dominated by banks' deposit liabilities, is equal, roughly speaking, to the growth of banks' assets, and these assets consist either of claims on the state, government securities mostly, or of loans to the private sector, claims on the private sector. So the growth of money depends on the ability of banks, the willingness of banks to grow these assets. Okay, now I'm going to start off with America, and if I may just for a moment look at my crib sheet and get me. This is available as a PowerPoint presentation which you can download if you wish. What you'll see here is the growth of money on both an annual 12-month basis and also on a 3-month annualized basis, where we look at a 3-month period and assume that the rate of growth of money in that 3 months rolls on for another 9 months, make a whole year. Look at these numbers going back to the Great Recession. See that great lurch downwards in money, and then this rather long period now of remarkable stability in money growth. The stability in money growth has also been associated with a stable economy. There's been roughly trend growth of output, above trend growth at the start, roughly trend growth of output with very low inflation. And I think what people are worried about is that there may be an end to this period of stability in 2018 as the Federal Reserve sells off the assets, runs off the assets that were acquired in the various quantitative easing programs from late 2008 to 2014. Now, the growth of money depends, as I say, essentially on these two things: the growth of claims on the government and the growth of lending to the private sector. In the period up to the end of 2014, the American banking system, including the Federal Reserve, hugely increased its claims on the American government because of the quantitative easing experiments. That stopped. And more recently, last 5 or 6 years, American banks have once again been lending positively to the American public and American companies. This chart shows you the rate of growth of bank credit to the private sector in the USA since the Great Recession. You can see at the start, when bank regulation was being tightened, banks were shedding their loan assets, actually negative numbers there, and then positive growth for a period. And then you'll see at the end, and this is really a little bit worrying, that actually the growth of bank credit turned down. The main reason for that was yet another tightening of bank regulation, particularly bank regulation on the large banks, large systemically important banks, often with global businesses, as on the view that these were very important to the business cycle, and the regulators decided to effectively punish them by having higher capital asset ratios than other banks. This sort of mindset continues. One simply can't escape it. It still is the case that banks have been required to restrict their asset growth, particularly the large banks. And I think my message from all this is that the rate of growth of the American banking system, and therefore the quantity of money, will be lower next year than this year. Hasn't been that dramatically high this year, but we're talking about, say, 4% or so. It may dip down beneath those kind of numbers as the Fed withdraws the QE assets, and also with bank regulation being tightened. And that then has wider implications, which I'll talk about in a second. But on the face of it, the growth of money in America will slow down in 2018 compared with this year. I don't think it's going to be that dramatic, and I don't think there's anything here to justify a forecast of a recession. But there may be a period of beneath trend growth, and I certainly don't expect a runaway world economy on the back of what's happening in the US banking system at the moment. What about the Eurozone? Here, again, we've got a chart which shows the history of money growth in the Eurozone going back 10 years or so, and various things to say. You can see the rather strong growth of money up until 2007, double-digit growth in 2000, annual rate in 2007, then the crash in money growth at the end of 2008 when new bank regulations came into effect, and then this period of falling quantity of money in 2009 and even on into 2010. And there was this boom in 2006, 2007, and then the Great Recession in 2009. What you'll notice here, though, is that the rather weak money growth rolled on for another 2, 3, 4 years on into 2014. And the Eurozone, unlike America, Britain, Japan, and indeed the world as a whole, had a second recession, period of falling output in 2012 and 2013. A fairly mild recession, but there was a recession. Of course, it's much worse in such countries as Greece and Portugal, Ireland, and so on. The background to this weakness in money growth in 2012, 2013, 2014 was that banking systems had worries about bad debts, were allegedly short of capital, and were being forced to raise more capital relative to their assets by regulators. They therefore couldn't grow their assets, and that then meant that money growth on the other side of the balance sheet was very weak, and that then dampened down the whole of the Eurozone economy. Also in the Eurozone, the Bundesbank was opposed to programs like the quantitative easing seen in America and Britain, and that was one reason, again, why money growth remained very low. Now this changed in early 2015 when a quantitative easing program was introduced, and you can see from this chart of money growth that the rate of money growth since early 2015 has been about 5% a year on an annual basis, And indeed, the annual line, that blue line, is practically a straight line since early spring of 2015. You might think that the ECB is targeting that figure. They say they aren't. Anyway, money growth in the last 30 months or so has been roughly double what it was in the previous 30 months. The economy has been stronger, demand's grown more, employment's increased, asset prices have gone up, and so on. And I would suggest that the doubling of money growth from 2.5% to about 5% has been the key influence at work. Now, this then raises the question of, how important was the adoption of QE as an influence on that increase in money growth. The way we'd identify this in the data is by checking on the holdings of government securities by the banks. And this is the chart that you want. This shows the change in the holdings of government securities by Eurozone banks, both commercial banks and the European Central Bank and the Euro system, on an annual basis going back to the late 1990s. What you can see in this chart is that in the first 10 years or so of the single currency, up to 2007, there were some periods when banks were acquiring some more government securities, some when they were losing government securities. On balance, not much change. This is when the loans to the private sector were booming, by the way, we'll see that in a second. But then since then, the banks have been building up their holdings of government securities, and this was, as you would expect, particularly true from early 2015. And if you take the whole of the period from the end of 2014 to today, the Eurozone's banks' holdings of government securities have risen by about 1,000 billion euros. Okay, that is QE, that is the QE effect. In other words, without that effect, you'd have had maybe not exactly 1,000 billion less growth of money, but certainly many hundreds of billions of euros less money growth than we've actually seen. That's a figure more like 2% rather than that 5%, and there wouldn't have been a Eurozone recovery. Now, the importance of this is that the current talk is that QE will stop in the Eurozone next year. I mean, we must watch this space, and that is being debated at the moment. But we do know, for example, that there are technical problems. Can the European central banks find the appropriate government securities and private sector securities to buy? One problem. I mean, there must be some limit to the holdings, I suppose, of Italian government bonds and Greek government bonds and issues of bonds by, I don't know, Italian parastatal entities and so on. I don't know. But there is some limit to it. And on top of that, the Bundesbank remains resolutely opposed to this whole program, this whole process. Well, suppose that QE then does stop in the Eurozone next year. Is it the case that the Eurozone's banks will increase their lending to the private sector? Well, to answer this question, let's look at this chart. This shows you, again, it goes back a long way, it shows you the rate of change of Eurozone banks lending to the private sector, credit to the private sector, on a percent basis, annual percent basis, back to the late 1990s. You can see we start off with rather high figures just before the euro comes in, slows down, then it booms again, okay? So 2006, 2007, we see bank credit to the private sector in the Eurozone as a whole growing at, what's the figure, almost 15%. No wonder they had rapid money growth, no wonder they had asset price inflation, and then they had the crash in the Great Recession of 2009. And then you see this rather long period in which bank lending to the private sector was going sideways or falling slightly, not so bad in the last 2 or 3 years, but not a proper recovery. Okay? Not like the USA. Okay? And indeed, the highest growth rate, about a year or so ago now, of credit to the private sector was about 3 or 4%. It's fallen back to almost zero in the recent past. What's the meaning of all this? My view about this is that Eurozone banks continue to face a capital problem. They have got some bad debts. They have got non-performing loans, particularly in countries like Italy and so on. They still have got unfriendly regulators. They're still under pressure to raise their capital asset ratios. That then means the growth of risk assets in 2018 will stay, well, there may be no growth at all. If there's no QE, what happens to the growth of money? It falls back, perhaps down to figures like 2-3%, the sort that we saw in 2011, 12 and 13, when there was that second recession. Look, policy may change, and it's still talking and debating, and these are hypotheticals and imponderables. However, I think again, one has to reach the conclusion that the growth of Eurozone bank risk assets will be rather weak in 2018, and money growth will be lower than it has been in the last 2 or 3 relatively stable and positive years. I also think that the worries that the Bundesbank has about other countries in the Eurozone will persist and may even intensify. We have, I can't explain the technicalities now, but we have this target 2 settlement system inside the Eurozone which shows the net debit, net credit positions of the different countries' banking systems. The German banking system has a large net credit of over 800 billion euros, and Italy and Spain together, each of them has net debit positions of getting on for 400 billion euros, and effectively on these balances no interest is paid, so in a sense there is a gift being made from Germany to the debtor countries. Well, obviously the Germans are not very happy about that, certainly not in the long run. I think if you put my 2 analyses together, the analysis of the American situation and the Eurozone situation, you would say the prospect is for somewhat slower growth of money in these 2 very important developed economies in 2018, and that then implies a damper to growth for the world as a whole, because these 2 economies are so important in 2018. Other things are happening. There may be positive developments in Japan, in China, in India, in Britain, and so on. One shouldn't get too negative about it all, but the analysis I've just given is unfavourable for the world economy in 2018. Having said that, I can see no reason for expecting a recession. I think the right view is trend or beneath trend growth after a rather good year in 2017 of trend, perhaps somewhat above trend growth. Thank you.